Hello and welcome to this edition of Hardman Talks. My name is Keith Hiscock. I'm the CEO of Hardman Co, and I'm joined today by Tom Dorner, who's a co-manager of the Polar Capital Global Financials Trust, along with Nick Brind and George Barrow. Great to have you here today, Tom.
Thank you.
Tom joined from Aberdeen, where he was a senior investment director in the developed markets team and managed the Aberdeen Europe ex-UK Income Equity Fund. He was responsible in particular for analytical coverage of European financials and managed a number of other European investment funds during his 9 years there. And before that, Tom was an analyst specialising in the European insurance sector at Citi and Lehman Brothers in London. And by way of introduction, Polar Capital Global Financials Trust, we might refer to it as PCFT from here on, is one of just two investment companies in the AIC's financials and financial innovation sector. And it's got assets just shy of 600 million and trades at an 8% discount to net asset value. Tom, you joined the team in the autumn of last year. What were your initial thoughts on joining the team as a fund manager? And what do you think it means for the portfolio?
Sure. Thanks, Keith. So in a way, it feels a bit like coming home. So as you said in your very generous introduction, I spent the best part of a decade running a European income fund, but always looking at financials from an analytical point of view. I've been involved with financials for the best part of 20 years, both sort of as an auditor and then as an analyst and then investing. So when this opportunity came to join a team that really specializes in the financial sector, it seemed like a perfect fit for me. The team's really great. All of us are very knowledgeable on the sector. My colleagues are very experienced. It's well resourced. And I think also it's quite an exciting time for financial services businesses generally, which I'm sure we'll get into. It feels like a sector that's getting its mojo back. So in terms of your question about what does it mean for the portfolio, to some extent, I think we can perhaps tighten up execution a little bit, and increasing the active share of the portfolio has been sort of part of that. But to some extent, it's more just continuity. The strategy's been around for a long time, and we just want to deliver incrementally better all the time. So it's more evolution than revolution.
Okay, so let's go straight to what you just said there, which is, what do you think makes financials interesting at this particular time for investors?
Sure, it's a fair question. I do think we have to recognize that for some time, financials have had a mixed reputation with investors, and the reasons for that are plentyfold. Low interest rate environment or a shifting regulatory goalpost, let's say, and there is this sort of negative muscle memory towards the sector. But I'd turn that on its head and say that's an opportunity from our point of view. If you take a step back, the sector is huge. It's very systematically important for the economy, and it's now generating much better returns than it has done in the past. So if we sort of try and unpick each of those a bit, financials are the second largest sector in global equities behind technology. So it's the sort of thing that clients shouldn't be ignoring. And it's actually a very diverse sector. Only about half of it represents banks. So there are a wide range of different companies, from general insurance, life insurance, asset management, stock exchanges, payments businesses. So that's a great opportunity set for stock pickers. I made the point that it's systemically important. But by that, I mean that it's really deeply embedded in the way the global economy works. So financial services companies intermediate $400 trillion of assets in the form of deposits, bonds, retail, and pension asset management. So it's just really embedded in what's happening. And if you think about things like transition to a more sustainable economy, that really depends on lending from banks or protection from insurance companies. So the sector's huge, and it's really systematically important. The final point to make is that the return profile, I think, has improved. So industry return on equities are much better for banks and insurance companies. And it varies a bit by subsector, but the fact is you struggle to find a sector that's better positioned for the sort of sustainably higher interest rate environment that we are in at the moment. So we think this higher return profile is there to stay. So hopefully that gives you a bit of a sense of it's large, it's integrated and important, and the return profile has just got a lot better as a sector.
So Tom, what are the key themes you're trying to tackle with the portfolio at the moment?
Yeah, these are fluid, the markets are volatile, but just to draw on a couple of them, a bit of the market that we've liked for some time and continue to like are commercial insurance and reinsurance companies. So these are companies like Arch in America or Munich Re in Europe. The industry backdrop for these companies has got materially better. Returns had been very poor in prior years from things like catastrophe losses. As a result, prices have increased a lot. The businesses are now growing at a rate that's pretty unprecedented in the last decade or so. And the benefit of that pricing increase has started to feed through into earnings and book value per share growth. So the companies can be volatile. I'm conscious we're in the middle of the hurricane season. We've already had Hurricane Beryl. But on balance, the companies are very well positioned in terms of balance sheet strength. So that's a bit of the market that we really like. Another area to flag is alternative asset managers. So we own Ares in the US, on ICG in the UK, and those are sectors that are seeing structural growth in demand for access to private markets, and that applies particularly in private credit, where some of the sort of traditional providers of credit, like banks, have sort of retrenched a little bit. And the business models are really interesting because effectively they tie up clients' money for a long period of time and they earn very attractive performance fees. So structurally growing with attractive business models. Now, there've been in recent months a bit of a sort of air pocket for private markets names realizing some of their investments. So we've got to be very careful as specialists which ones we own, and we've tended towards the larger names that have tended to do better than some of the niche players. But the long-term drivers of those stocks are still very attractive. So alternative asset managers is still an area that we like. And maybe a final area to flag is we have some holdings in emerging markets. Generally speaking, we've perhaps been a bit more cautious on that space, but there are some really interesting opportunities. So we own a few Japanese banks and they've done quite well, but something that we've engaged with more recently that we're really interested in is Korean banks. So for a long time, Korean banking sector has been effectively a value trap because of governance issues. And having seen how successful corporate governance reform has been in Japan, in Korea, there's now this Korea Value Up program, which is effectively trying to replicate some of the governance improvements, and has started to, even though there was an election in Korea earlier this year, that momentum started to be maintained. So our view is, for the valuations at which these banks trade, the upside potential, if some of this governance reform takes hold, which we think it will do, is pretty substantial. So a couple of areas there that we're finding interesting: reinsurers, commercial insurers, alternative asset managers, and emerging markets, just to name a few.
Thanks, Tom. Let's dive a little bit deeper, if we may, into banks, which, as you say, is the biggest part of the sector. Looking at the banking sector across the piece, what are your latest thoughts on the outlook for it and the valuation of the sector?
Sure. So the area within global banks that we've been most positive on for a while and continue to be is European banks. So they've been, so having done run European funds previously, I'm acutely aware it's been a pretty challenging bit of the market in which to make money since the financial crisis. And I think there is still this component that investors have this negative muscle memory that we were talking about before. But actually, trying to be a bit more objective, the banking sector in Europe went through COVID very well, has dealt with an inflationary backdrop very well. Asset quality has been pretty good. Capital positions are very strong. And the end result of all of this is that they've made very substantial capital returns to shareholders in recent years. In fact, for the first time ever, the share count of European banks is reducing. So capital allocation discipline has been very good, despite some pretty challenging backdrops. And valuations remain attractive. The stocks have actually done quite well, but they've seen very substantial earnings upgrades. So you're still looking at PE multiples at 7 times forward earnings. So those haven't really increased a lot. To give you an example, we own UniCredit Group in Italy. It's one of our biggest positions. That business has really transformed itself. It's got an excellent management team with a clear strategy. It's now delivering strong return on equities and made substantial capital returns. So European banks, I think, in global banks is the part of the portfolio where we feel most excited.
Okay, moving on to I guess the next biggest part of the financial sector, insurance companies. Are they good investments in an era of higher inflation?
Uh, yeah, so the answer to that, it depends whether the insurance company that you invest in is able to spot the impact of inflation on their claims costs and has the ability and willingness to pass some of that on to customers. And a bit of the portfolio that we've engaged with recently is the UK motor insurance sector. It's an interesting example of how inflation has impacted insurance companies. Profitability had been terrible for the last couple of years, and that was because the higher inflation after COVID effectively meant secondhand car prices and labor costs were inflated, so claims costs for these insurance companies shot through the roof, and the speed with which the industry detected that was too slow, and that really had an adverse impact on profitability. But we thankfully managed to avoid it through the bad news effectively. But what we found in the last year or so is that that distressed profitability has led the sector to start raising prices quite meaningfully. Last year, anyone who's had a renewal quote in the UK will have suffered from this. So prices have gone up substantially, and consumers are frustrated about that. But the industry is cyclical, and when it doesn't make money, the prices start to rise, and that's good for future profitability. So I think our view would be that UK car insurance companies now in a position, having suffered from higher inflation, to your point, are now in a position to see pretty meaningful earnings growth, and that eventually translates through to dividends. So there are some interesting opportunities in the sector, even if inflation is higher.
And we've seen an increase in M&A activity in the financials. Is this providing you with opportunities?
Yeah, so M&A activity has picked up globally and across sectors within financials. So there's been some large transactions in US credit cards, some smaller regional banks have consolidated too. There have been a couple of high-profile names in the UK. I think the Nationwide Virgin Media transaction has been approved today. There's the various ongoing rumors in Italy and potential consolidation in Spain. So it's undoubtedly the case that activity levels for M&A have picked up. We haven't seen anything large scale, but there is opportunity for us to try to take advantage of that. I would say that our primary focus is to look for businesses that we like from a sort of fundamental point of view, and if they happen to be involved in M&A, that's an icing on the cake rather than something that we're trying to take advantage of. But I think the increase in M&A is sort of symptomatic of an increase in confidence that financial services businesses are experiencing, and it's a sign that the strength of their balance sheet sort of returned as a factor in the sector. So with stronger balance sheets, better capital return discipline, and a bit more confidence, it's understandable that management teams are now thinking, right, can I do something better than just do large dividends and large share buybacks? So M&A sort of seems to fit that bill. Now, it's something that it matters a lot because we think the discipline to return capital through dividends and shareholders has been one of the things that made the sector very attractive. So we need to be vigilant that the companies we invest in don't squander that capital strength that they have and do something that's ill-disciplined. So we have to be very careful what sort of stocks we invest in. We want to be careful that they're not making bad acquisitions, but by and large, I think it is increased M&A is good for our sector because it's showing you that mojo is coming back.
AI is the buzzword at the moment for investors. What does it mean for financial service companies? Is it a risk? Are there opportunities from it?
Yeah. I mean, the most tempting thing is to just say, well, of course, AI is a huge opportunity for financials. And frankly, lots of management teams in lots of sectors have sort of jumped on the bandwagon. And I think there is a risk that we get too euphoric about this and exaggerate what the potential benefit is. There are plenty of examples of things that people get excited about that sort of fall by the wayside over time, like the metaverse. No one remembers that anymore. But that sort of point aside, I think anyone who's used ChatGPT or Google Gemini can see that there are aspects of this artificial intelligence movement that are really powerful. So there are a couple of things that perhaps to flag in respect of financials. So firstly, as a sector, both banks and insurance companies have been dealing with disruptions of sorts from fintech companies or insurtech companies for quite some time. So it's a sort of an ongoing part of the way that they operate, that they deal with new startups or new technologies trying to disrupt their end markets. And in fact, actually, in the trust, we invest in some of these fintech disruptors where we're confident that there's sort of longevity of that disruption potential. The thing to bear in mind, though, is that some of the larger incumbents have huge resources with which to invest in technology, including artificial intelligence. So, I mean, JP Morgan, for example, spends more than $15 billion a year on technology. So that really does put the incumbents with the resources and the management sense to think about how to deploy those in a good position to take advantage of these technological movements like artificial intelligence. So that's a point worth bearing in mind. Another point to make is that both banks and insurance companies and financials in general have a lot of information about their customers. So perhaps there's a way in which some of these large language models can be used to exploit that data, either to better price loans or insurance products, or to find more effective ways of cross-selling other products. So that could be an opportunity. I'm not sure that AI is necessarily different to what the companies have been trying to do, but perhaps the effectiveness with which they can exploit that data has improved. So that could be interesting. And a final point to flag on the implications for financials is just, it's a point around cost efficiency. So I've seen some fascinating data by Accenture, which looks across many different industries, and it flags that banking and insurance companies in particular have the highest proportion of their workforce that could be impacted by AI-related automation. So that means that could either mean scope for cost reduction, or it's scope for using those employees more efficiently to add more value. Whatever it is, it feels like the financials have potential to be more efficient as a result of automation from artificial intelligence. So I think there's more to come. So those are a couple of things that are how artificial intelligence might affect financials in particular.
Now, about half the portfolio is in North America, and you must be thinking about what the impact of a US election, or in particular a Trump re-election, might be on the space. What are your thoughts?
Sure. So the US election, it's obviously important for us. Now, I mean, not just as you say, because we've got a lot of the portfolio there, but because the outcome of the election might have an impact on the trajectory of inflation and what that means for interest rates, which clearly has an impact on financial services companies. So you can start to see actually that the sort of more recent developments with the probability of Trump being re-elected having gained some more momentum means that some bits of the sector and broader markets are starting to move already in anticipation of that. You start to see smaller cap companies are starting to do quite well. US regional banks in particular have seen a lot more momentum. So it is starting to have an impact. So therefore we have to sort of think about it. I mean, if you think about Trump's policies in particular, they are very aggressive and they're, let's say, very fluid. So I mean, lower taxes, trade tariffs, lower interest rates, deregulation. I mean, there's a lot of things there, and we have to sort of be sensible about how much of that is actually achievable rather than getting too exuberant about it. But whatever you make of the sort of underlying politics, it is starting to move markets. So it's something that we do have to keep an eye out for, and we have to look particularly for which bits of financials, like perhaps US regional banks, that are better positioned to benefit from a reversal of regulation. I mean, a point to make though is I was just reading this morning. There's a YouGov poll published 2 days ago, and the degree of lead that Trump has is not as big as the media might lead you to think it is. So I think it's something that it is important. We are monitoring it. We are looking for ways to exploit it, but let's not let the media hype get us too animated. Because, I mean, as we were saying before, our expertise is to try to find good businesses within financials that we can invest in. The US election might be a factor, perhaps more in portfolio construction than it is in the single stock ideas sort of thing.
Okay, so finally, Tom, would you like to summarise what PCFT offers investors in this environment?
Yeah, I'll try and do that. So we think that the Financials Trust gives investors an opportunity to sort of access a sector that's actually really seeing some exciting positive trends. Financial services companies are large, they're systemically important, and they benefit from some strong thematic tailwinds, not least of which is a higher interest rate environment. At Polar, we've got a really fantastic team of financial experts that focus on nothing but trying to pick the best stocks within that sector. Our trust is, as you were saying in your introduction, one of the only ones focused on global financials. So we think it's differentiated. It has been around for almost a decade. So we think we've got plenty of experience to draw on to try to make those investment decisions as optimally as we can. Our hope is that the trust offers clients a way to perhaps diversify away from allocations towards more growth-oriented investments, and they can consider that at a time when I think it's fair to say that asset allocators are still quite negative towards financials for reasons that we've discussed that might be somewhat outdated. So I think considering financials at a time when they're still quite attractively valued is quite an interesting opportunity for them to create value for clients. So hopefully that gives you a sense of how we're thinking about things.
Thanks, Tom. Thank you very much for your time.
Thanks very much, Keith.
So the Polar Capital website has a wealth of resources for investors to look at. There you can find more detail, for example, about Tom's fund. The Hardman Co website also has a lot of material on investment companies. And as always, thank you for watching. Please don't forget to like this video and join in the conversation wherever you're listening or watching. We'll see you next time.